And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Luke Smith, good afternoon and welcome back to the studio.
Mate, how nice is today?
Oh yeah, the weather's cracking.
Oh, it is. Someone's looking down on us from somewhere because we've had a stretch this week that's been absolutely top shelf. And we're sitting here today and it's not 34 degrees in the Sahara Desert, so big props to the air conditioning people too.
Well, you see, it's not working the way it should be either. I regret to report.
well, it's better than it has been in previous weeks.
Well, you know, they fixed it and then all of a sudden it wasn't fixed anymore and I've had to put it back on 18 cold. But it's not 18 yet, as you can tell.
Well, my office runs at a sweltering 26, I reckon, so yeah, I'm definitely outnumbered boys to girls there.
Anyway, this air conditioning report was proudly brought to you by Envision Financial because you're paying for the time, my brother.
That's all right.
Luke Smith from Envision Financial. What is the difference between a self-managed super fund and a personal super fund? This sounds like a highly technical question.
No, look, it really isn't, and I guess I just want to bring this one up because it's becoming more and more prevalent that people leap from industry fund to a self-managed super fund and don't realise that there's something in the middle. So if we break down different types of super funds, we keep in mind that all funds operate under the same rules. And I often say in my office, a lot like a motor vehicle, different cars have different features and different cars have different purposes. I don't drive a Mini. I'm 6'4", 6'5". Wouldn't be a good look for Mini. I probably wouldn't get in one either.
Well, you know, the modern day Minis are actually not that mini.
No, and
they're twice the size of a real Mini.
And they're an absolutely cracking vehicle.
Oh yes.
That I would very easily and happily buy for my girls. But for me, not the greatest. And I use that analogy because super funds are exactly like cars. What you needs to be considered in relation to the features of a car. Tradies drive utes for a reason, right? They've got to throw stuff in the back.
Everybody else drives utes for no reason.
Correct, exactly right. They can park in ladies, that's much to the tradies' frustration. But super funds are the same. If you want a self-managed super fund, you're going down that road for a number of key considerations. If you want something between a self-managed super fund and an industry fund, that's when we start to talk personal super fund or retail super fund. And the easiest way to think of a distinction, a self-managed super fund allows you to be the trustee, so you are the controlling entity of that fund, and you must adhere to all of the legislative requirements of the superannuation industry. A personal superannuation fund has someone acting as the trustee for you. Now, some names that people would be familiar with would include retail super funds offered by Macquarie, Colonial, MLC, BT, Hub24, Netwealth, just to rattle a few off. Now, that's a great example of a retail super fund. Corporate governance is done for you. You are still a member of the fund. There is an approved product list that the personal super fund allows you to choose from. With a self-managed super fund, you can invest in just about anything you like, provided that you are doing it within the realms of the legislation. A self-managed super fund, you are responsible for selecting and administering the fund. As I said, the personal super fund, that compliance work is done for you. Now, the menu in a personal super fund is great. The menu in a self-managed super fund is great. A personal super fund or retail super fund will not allow you to hold a physical property. Okay, this is one big point of differentiation. A self-managed super fund will allow you to own a commercial property, a residential property, a physical property asset. A personal super fund will not let you do that. So if you want to own the factory that you run your business in, a personal super fund is not going to be right for you. If you don't want to be responsible for the ongoing compliance obligations of running the SMSF, then a personal super fund will be better for you because that will be done for you. So I find people muddy the two together very, very quickly. I also find that retail super funds or personal super funds get stepped over when you talk to someone that says, oh, I'm going to go from an industry fund to an SMSF. No, you can use a retailer or a personal super fund in the middle, because with a personal super fund, you can control the income that's generated from your investments, and you can control the use of franking credits that are generated within your portfolio. Now, you have no control over that in an industry fund because they're unitized investment vehicles. They don't pay dividends, okay? They just say the balanced option started the year at $1 a unit and it ended at $1.06, $1.10, $1.20, $1.09, $1.04, whatever the total performance is. A self-managed super fund and a personal super fund allow you to generate dividends that you have greater control over, to be able to then potentially fund the pension that you're going to draw to meet your living costs. So again, you're looking at the super fund and saying, what flexibilities do I want to have some greater control over? If managing your income, managing your franking credits, managing the tax and the estate planning controls to the next generation, if those things are important to you, then a personal super fund or a self-managed super fund would be more appropriate vehicles. If you just want something that will give you the balanced option and you're not entirely fussed about being engaged with the process, that's also totally fine, and that's where an industry fund may be right for someone. So I use that analogy of what sort of car do you drive to get an idea of the key features from people as to why they have the cars they have. And when you break down those points of differentiation, people can then clearly see that not all funds are the same, and you pick the right fund for the right purpose.
So, in other words, if we're going to use the car analogy, a self-managed super fund is like a car with a manual gearbox where you can make your own decisions, and the personal super fund that's run by one of those names that you mentioned before is like a car with an automatic gearbox. You don't have to worry about changing gears.
True, but the personal super fund has paddle shifts. Let's take it another level. It has the paddle shifts instead of being manual. But you have far more choice and control.
I thought I'd throw that in there.
No, I like it. I like your analogy. I'll use that in the office.
I believe fees are different too between the self-managed super funds and the personal super funds.
That's right. So a self-managed super fund generally works on a fixed fee basis, and a lot of wholesale superannuation accountants now either work on the number of assets in the fund, or they will look at the composition of the fund and say the cost is X. So you have a lot of transparency, and for larger balances, a self-managed super fund is generally a much cheaper structure when you look at the cost of using the vehicle. Personal superannuation funds generally have a tiered pricing structure that reduces as the balance goes up, and a lot now cap out at around $1 million, where anything over a certain fee of say $1 million at 0.15, so $1,500 a year in admin fees. Anything over that is completely free. So they are very, very competitive in relation to pricing. And that's where people need to remember that if you can get access to a wider range of investments, you can reduce your total investment costs to the point where personal super funds and self-managed super funds can actually be a lot cheaper than a comparative industry fund through the selections that are made. Because with more choice comes more control. With more control, you can now focus on reducing your fees. And everybody loves reducing their fees, but they also love reducing their fees and having a lot more options. And that's where it comes down to saying with someone, well, what are the things that are important to you? And most people come in and say to me, I want to have control over my income when I retire, and I want to have growth to offset inflation that is relevant for me. If I had to narrow down 2 or 3 things that everybody says to me, it's exactly those. Because I think people's focus changes significantly up until the point where they want to draw their income out, and they're happy to have and get whatever they get along their working journey. But now when it's directly related to their lifestyle and the controls that they're after, I find people become far more engaged in the process in that pension phase, because they're not only thinking about their taxes, they're thinking about their investment costs, and they're thinking about the next generation and having control mechanisms in place to be able to mitigate tax when it comes to passing assets to that next generation.
So what sort of situations or circumstances would be important to consider when you're choosing either option?
Yeah, so if you were going to go down the SMSF or personal super fund road, you would be thinking about investment choice and flexibility. Do I want to be able to choose from a very broad and wide range of investment options? That should include individually listed shares, exchange traded funds, some specialised managed funds, converting preference shares, a range of different investments that can give you control over the dividends that you generate, as well as the franking credits and the use of those franking credits. Also thinking about with a self-managed super fund, they are a very, very flexible vehicle. If you were to run multiple pension accounts between, say, you and your partner out of one fund and limit the need to run 2, 3, 4 different super funds to achieve different tax planning strategies that could be available. So it's really about the control of the assets that you buy, control of the fees that you incur, as well as being able to have control over the income that's generated and ways that you can maximise franking credits, which in a pension environment come back to you as cash. So it's very important that people understand that moving into retirement, because that's a great way of having control over the bolstering of income and the bolstering of your return throughout a financial year.
Okay, and conversely, going to the personal super fund, you might be giving up some of that control, but there's a trade-off there. You get the benefit that other people take charge of certain things that you can then not worry about.
Yeah, look, exactly right. And I think, again, for me, a personal super fund and a self-managed super fund, accountants, they're 80 to 90% the same, without a few clear distinctions like the trustee issue that we had, and then the physical buildings that you can buy. But if you want to buy a diversified portfolio of listed investments, then a personal super fund will give you a really, really broad range of options. Probably buy anything in the ASX 300, as well as exchange traded funds and probably 1,000 different managed fund options. So your average retail investor, if they're not going to go out and buy collectible cars, pink diamonds, paintings, or you want to have 100% of your super fund in BHP, then a personal super fund is a really, really good halfway home between a self-managed super fund and an industry fund. But I just find a lot of retail consumers jump from industry fund to self-managed super fund, not knowing that this hybrid, if you like, is in between, which could be very, very flexible and very, very efficient for them, because people want to retire. They don't want to be an administrator when they cease working.
And that seems to be the big benefit of the retail personal super fund, is that somebody else takes care of the basic administration tasks and of course deals with all the tax matters.
Exactly, that's right. So you pay an admin fee to be in that fund, and as part of the admin fee that you pay, they will do the tax return, they will sort out the franking credits, they will do all the consolidated reporting of the underlying investments. So all of that is done for you. Whereas with a self-managed super fund, you need to pay an accountant to do a tax return for the fund, as well as an audit. And with an industry fund, your internal cost ratio, your fee for investment, that covers all of that processing as well. So, a lot of these funds have similarities, but you really need to sit down and say, well, what are the controls and flexibilities that are important to me? And then decide which fund you use. I just want people to take from today that a personal super fund is a very, very cost-effective and flexible vehicle that is between an industry fund and a self-managed super fund, because the self-managed super fund is not for everybody, and the same can be said for an industry fund. It's finding that right vehicle for your needs in retirement.
Yeah, it certainly seems to me as a layperson that a self-managed super fund entails a bit more work.
It does for somebody like me. For the member and for an advised member of the public, I often say to people, can you sign a tax return? And they say, yeah, of course. And that's really their extent of their engagement. If you were mum and dad at home and running it yourself, then yes, there'll be a lot more engagement required if you are not receiving advice or having somebody do that for you. But for me, I find the self-managed super fund at the right capital level is the most flexible vehicle that you can use, with the personal super fund coming a close second for a lot of people for a range of different reasons. But again, we just want people to know that they are there.
11 minutes to 5, and Luke Smith from Envision Financial is with me in the studio today. We're talking about what is the difference between a self-managed super fund and a retail personal super fund. Back with more in just a moment. 7 minutes to 5 on 2CC on a Friday afternoon, which means, of course, Luke Smith from Envision Financial is with me in the studio today. We're talking about the difference between a self-managed super fund and a personal super fund. So, Luke, what are the key things to consider when deciding on what's the right super fund for you?
Yeah, look, I think we touched on some of the key points of differentiation before the ad break, but really you're going down this road to say, what are the things that are important to me during my accumulation journey while I work, or when I move into pension phase and want to draw an income stream out of my accumulated super. The key things that I get from a lot of people are control over my assets, more importantly, control over the income that my assets generates, as well as use of franking credits and ways to maximise the efficiency of our accumulated assets between a couple, thinking about the tax implications of superannuation to non-dependent children. Now, the two vehicles that we've spoken about today to separate are both indications, be it a self-managed super fund and a personal super fund, great ways to have more control over the way that your super is invested, and potentially a much cheaper way of going about that investment process compared to other alternatives. And we also said that, simplicity is appropriate for some people, and that might be where a personal super fund is chosen over a self-managed super fund. From a cost perspective, one big misconception is that self-managed super funds are expensive. When you start to get in excess of $800,000 between for an individual or a couple, they can become very cost-effective vehicles. So again, dispelling that myth that they are expensive out of the gates is a bit of a fallacy. The investment menu and the things you want to buy are very important. So a much wider range in a self-managed super fund because it's effectively unlimited. A personal super fund will have an approved product list, and that is a selection of assets that have been researched by the super fund provider that the trustees of that fund are comfortable for you to use. I think people need to also think about how they want to retire and their level of engagement, because your level of engagement around what happens will be a direct contributor to the type of fund that you wish to use, as well as your general understanding of what is happening. If you don't want to be responsible for the administration of your super, personal super fund, great. If you want to be more involved and have some additional flexibilities, that comes at a price, and that could be that you are legally responsible for the mechanics of that fund. Now, you outsource the mechanics of that fund to somebody like me or a trusted accountant, etc., etc. So you don't think that you need to go it on your own, but I think control, flexibility, peace of mind, income distributions, use of franking credits, and transparency around fees are all the key reasons that I find people go down the road of a personal super fund compared to other alternatives.
So, Luke, where can listeners get more information?
Yeah, the office number is still 6260-4749. We have envisionfinancial.com.au on the internet. We've got the podcast, the strategy stacker Luke Talks Money on iTunes and Spotify. We have the YouTube channel Envision Financial Canberra, where we have all of the shows. We have YouTube Shorts. We have the strategy stacker handle on the TikToker, and all of these superannuation options are detailed in Smart Money Strategy, your ultimate guide to financial planning, available in all good bookstores, Amazon, Dimmix, Booktopia, and just about anywhere else you can find it online.
Absolutely. Remember the title, Smart Money Strategy, your ultimate guide to financial planning. Luke, thanks very much for coming in.
We'll see you next week.
We'll see you again next Friday afternoon at the same time.
Will do.
Luke Smith from Envision Financial back with us again next Friday on 2CC. We'll talk money matters some more. It's about 3 minutes to 5. All the latest news is coming up next.